Hi, I'm Will Benedicts with the Proctor Dealerships, and welcome to another episode of Proctor Car Tips. Today we're going to go over the most common questions that we get about APRs and financing your vehicle. One of the biggest purchases people will make is an automobile. When you borrow money for an automobile, you have an interest rate. The interest rate is simply the premium that you pay for borrowing the money for your car. Now, a lot of people will ask us, what's the difference between an interest rate and an APR? An interest rate is simply what you are charged to borrow the money. For instance, 2.9%. Your APR, or annual percentage rate, is the true cost of the money. That may include any fees the bank imposes for that loan being given to you. One of the biggest questions we get asked is, what is my interest rate? Well, right now, according to Bankrate, the average interest rate is just over 4%. But the rate that you get on a car is really going to depend on what's shown in your credit report. And those rates can vary anywhere from 0% all the way up to 16% on a new car in the state of Florida. Your interest rate is determined on a myriad of factors, the majority of which is going to come from your Beacon score. Now, a Beacon score is a judgment of your credit worthiness. I'm sure most people are familiar with the three credit agencies, Equifax, TransUnion, and Experian. What most people don't know is those agencies only keep track of what your credit file contains. It won't actually give you a score. That's done by a company called Fico. Fico stands for the Fair Isaac Corporation. They have a virtual monopoly on giving out FICO or Beacon scores. And the matrix they use to give that out is one of the most closely guarded secrets that they have. As a matter of fact, if you're using a credit monitoring company, the scores that you get are not going to be your actual FICO score, which is what all auto loan and mortgage companies are going to go off of. Now, the criteria that FICO uses to create these scores that all banks are going to look at to determine how your interest rate's going to come out is 35% weighted on your payment history, how well you have paid everything that's in your credit file. The next one, 30% of it, is weighted on your debt burden. What they mean by debt burden is, let's say you have credit cards, and those credit cards you can charge $30,000 on, and currently you have a $27,000 balance. That makes your debt burden very, very high. It's going to have a dramatic impact lowering your FICO score. Conversely, if you have $30,000 of available credit and you're only carrying $2,000 on there, your debt burden is very low and your FICO score will go up. Which brings us to another very good point. Just because you're not using a credit card doesn't necessarily mean you should close it. That may not help your credit. 15% of the criteria is the length of your credit history. How long have you had a credit file? Have you had just 2 credit cards as a recent college graduate? Or have you been in the file 15 years with a house and multiple car loans? 10% of it is going to be the type of credit used. If a company sees that you've only used maybe 3 credit cards and 1 installment loan, you're not going to have as high of a Beacon or FICO score as if you had multiple different types of loans that were all managed very, very well. The bottom 10% is going to be how often your credit has been pulled in the last few months. That shows the company how much credit you're looking at taking out and how much of a risk you may be in the future. Those 5 items put together gives you a FICO score which can range anywhere from 300 to 850. 300 being the lowest, 850 being the very highest. All the banks are going to use those criteria that they get from Equifax, TransUnion, and Experian with the FICO score provided to judge what your loan should be. Keep in mind, that's not the only criteria, but it's over 50% of it. The rest of the time, they're going to have internal scores that all different banks will look at. That's why certain banks may come in at 2.5%, while another bank is at 3.2%. One other thing to bring up about your FICO score. There are certain things that they are not allowed to take into consideration when they give you that FICO or Beacon score. Your age, sex, gender, race cannot be taken into consideration. Where you live cannot be taken into consideration. What you do for a job cannot be taken into consideration. Now, we've talked about your Beacon and your FICO scoring, and a lot of people subscribe to a credit monitoring service to make sure that their scores are on the up and up and to make sure that nobody is trying to steal their credit. Those are all well and fine, but there is only one place you can go to get your true FICO score. The rest of the times, what you're being provided with is what some people call a FACO score. It's used a different matrix than the one that FICO uses. That's why sometimes when you go in to get a loan, you expect that your credit's 710, just like your credit monitoring service told you. But when you're at a dealership or the mortgage company, they tell you it's a 680 Beacon, because FICO is the only one that lending institutions will use. If If you want to know your FICO scores, go to myfico.com. It'll cost you $20 and you can get all of your FICO scores. One of the other biggest questions that we get asked is, what beacon score or FICO score do I need to be able to buy a car? That's a very subjective question. You can be able to buy a car with a 400 beacon. You can also buy a car with an 800 beacon. It depends on quite a few different things that the banks are going to look at. Some of those intangibles are going to be, how much money are you putting down? How much of a risk does the bank take to extend this loan to you? How many auto loans have you had in the past and how well have you paid them? Generally speaking, the banks want to see at least a 600 or higher for you to get qualified for an auto loan with minimal money down. Another great question we've had is, how is the interest calculated on an auto loan? There's three types of different loans, three basic different types of loans. Those are simple loans, compounded loans, and there's the rule of 78s. We're going to ignore the rule of 78s for this segment because it does not apply to the auto loans done in the state of Florida. A simple interest loan and a compound interest loan. Compound interest is like your credit card. You literally pay interest on top of the interest that has accrued. Over 95% of all auto loans done are simple interest auto loans. Let's take a look at how a simple interest loan actually works with the interest and payment calculations. We're going to assume you're buying a $20,000 car at a 5% interest rate and 5% APR. Take a look over here with me on the board and let's go through how the bank actually calculates your auto loan and then a quick way for you to do it in your own head. So here's the formula that banks will use for simple interest loans. Really simple, isn't it? This formula is how you figure a monthly payment. A equals your monthly payment, P is the principal balance of your loan, R is your interest rate, and N is the term of your loan. If you remember back to algebra, what we've got here is your principal balance, your interest rate to a factor, your interest rate to another factor. We'll take the $20,000, we use our interest rate. Keep in mind the interest rate for this loan was 5%. Take that 5% and divide it by 12 months. This is amortized monthly. You get a 0.416% interest rate. That 0.416% made into an actual decimal is 0.00416. If we would do math all the way down the board, you wind up with a payment of $380. Now let's look at a simple way of calculating your auto loan. So you're looking at a car that's $20,000. We're going to use the general rule of thumb here. These numbers represent how much per $1,000 you finance. If we look right here at 60 months, it's $19 to $25 per every $1,000 you finance. $20,000 times $19 a month is $380 monthly payment. That's the same payment we got using the complicated formulas before. You can also see for 48 and 72 months. If you use these and multiply them times every $1,000 you finance, you'll get very close to what your monthly payment is going to be. Now, another thing that we need to talk about is how do we calculate the amount of interest charges on your loan? That one's really simple. Take your total monthly payment times your loan length. 380 times 60 months is $22,800. You borrow $20,000, subtract that difference out, you're paying $2,800 in finance charges if you make all 60 payments. Sometimes people are slightly hesitant to have their credit pulled. They're afraid of what that credit pull is going to do to your credit. That is a valid point. However, most people are not aware that if you are searching for a mortgage or auto loan, it is written into law that for 14 days, any credit pulls that you get from any bank for that auto or that mortgage loan have to be combined into just one credit pull. Meaning, if you shop 5 different banks for auto loans, you not get shown 5 different credit pulls on your bureau. It only gets taken into account for one as far as your FICO score goes. Now let's take into consideration paying cash versus financing. You're looking at a $20,000 car and you have $20,000 in the bank. Why should you finance that car? There are certain circumstances where it's much more advantageous for you to borrow the money for that car than it is to just pay cash for it. For instance, if you have a mortgage, let's say you have a $200,000 mortgage and you're 10 years into it. Instead of buying the car with $20,000 in cash, put that $20,000 down towards your mortgage. You will save yourself just shy of $25,000 in finance charges over the life of your mortgage because you financed your car. 70% of our graduating college students have student loans, and the average repayment term is almost 20 years. If they were to take that $20,000 and put that down on the student loan versus paying for the car with it, they will save themselves over $10,000 in finance charges. If you have a mortgage if you have student loans, you should not be paying cash for your car. Over the long term, you'll save yourself thousands and thousands of dollars. We get questions about used cars and financing. Usually, why is the interest rate so much higher on a used car? The reason is there's more risk for the bank. If you're financing a brand new car, it's going to have somewhere between 3 years and 5 years of warranty on it. Used cars, let's say one with 70,000 miles, is going to have very little warranty. The bank is at a higher risk of default when somebody can't afford to pay for those car repairs. An older car is also going to start having more problems. Even though they may be financing less money, the amount of money they finance versus the value of the car may not be as good as the new car. Is there any difference in the way the finance charges are calculated? Absolutely not. But the older the car is, the higher your interest rate is going to be. Another thing people ask us with used cars is, how old of a car can you finance? Once again, the answer is it really depends. Generally speaking, your primary banks don't like to go past 6 or 7 model years. Now, certain banks will pick up all the way up to 10 model years ago, but you also have to take in mind how many miles are on the car. If it's an 8-year-old car with less than 50,000 miles and you have excellent credit, 720 or higher on that Fico score, there's a chance a bank will finance you, but probably just for 2 or 3 years. The reason being, older cars are more of a liability for the banks and the default rate is higher. If the risk is higher, the interest rate and the APR that they transfer to you is going to be a little bit higher. I'm Will Benedicts with the Proctor Dealerships. Thank you very much for watching our video today. If you have any questions, please leave a comment below or click subscribe for more Proctor Car Tips.